going to read the rest of this just so that there is a verbal record. This is what I wrote exactly 1 year ago today. I'm going to pick up where I start. There's really little action taken to correct policies that are identified as problematic before they reach a crisis point. There is, on the other hand, this opportunity to comment on the essential concern of our economic basis. I believe it is supposed to be a record of an investment in the future of America. So let us begin. Quoting, that the exclusions of 1 to 4 family residential properties would not include credit facilities that solely finance land development activities, such as laying of sewers, water pipes, or similar improvements to land, without any construction of 1 to 4 family residential structure. In order for a loan to be eligible for this exclusion, the credit facility would be required to include financing for construction of 1 to 4 family residential structures. End quote. How does this affect bundling of mortgages for packaging or use for other finance deals, as well as clearinghouse aspects connected to mixing of assets with different risk weights, including ones not eligible for exclusion? Long-standing concerns involve bundling of mortgages with varied risk factors into packages that may not accurately identify the needs of the mortgager or be able to identify questionable concurrent transactional process. A concern still exists in permitting the leveraging or swapping of toxic assets as part of these bundles in manners that may facilitate illicit financial activities. How will a 1 to 4 family structure exclusion requirement in connection with revised financing rules address this concern? Quote, as described in the supplementary information section in the preamble to this proposed rule, the OCC believes the change to the treatment of land development loans for the purpose of the 1 to 4 family residential properties exclusion and the definition of HVCRE exposure will result in an increase in future required capital once existing HVCRE land development loans roll over. End quote. How will local efforts to acquire other security instruments in order to finance capital improvement projects be impacted in the course of promoting new rules connected to refinancing of new or existing mortgage financing of this sort? Will there be comparable rule changes regarding financing or refinancing of new or existing capital improvement or other bonds in connection with this rule change? This level of financing would also include assessments of existing mortgage rates and property values. This could have a profound impact on smaller lenders and self-mortgaged options for those who prefer to avail themselves of such. HUD policy recently changed to remove the 10-year mortgage period requirement and maintain only a 1-year warranty on repairs to housing. This means some HUD properties could be flipped or included in bundles with others that have to be considered with the HVCRE standards applied. A great deal of the urban considerations in the period leading up to the collapse of the real estate market in the mid-2000s had to do with processes of flipping mortgages. The recent HUD decision compels a consideration of anticipation of a serious shift in new HUD housing, as well as the finalization of previously engaged HUD financing that will term out soon. Attempts to report on fraud involving HUD housing programs have yielded little in the way of regulatory change to prevent further fraud involving public housing allocation or assessments of housing needs regarding publicly financed housing. This could have a profound impact on market participants in regards to new financing or refinancing on existing mortgages that may be recharacterized. In Houston, Texas, in the summer of 2017, a report was issued concerning an outstanding $30 million of $51 million in affordable housing bonds that was unaccounted for after many years, right as the city of Houston was approving changes to its local flood mitigation plan. Following Hurricane Harvey, however, there was a request for emergency assistance without any follow-up on the reports concerning the outstanding non-emergency funding that had already been voter approved and issued to the city of Houston years earlier. This included a buyout of existing housing that was already slated to be affected by the non-emergency decisions of the municipality regarding changes to its flood mitigation strategy. It also included a request for HUD assistance, ostensibly to address concerns regarding the effects of Hurricane Harvey. The concerns regarding local plans for floodplain upgrades come under consideration in this regard. In the event that floodplain upgrades are to be incorporated into new or existing residential development, new financing or refinancing will need to be acquired in order to be compliant with requisite floodplain upgrades. It is important to factor these into the cost of financing package in a manner that does not compel an emergency appropriation or categorization of emergency related financing as a substitute for efficient and fiscally sound budgeting. The concerns around upgrades to the floodplain plan have been in development for nearly a decade. It is inappropriate to not factor them in at this time in regards to any new rules concerning financing or refinancing, especially insofar as they are also factoring infrastructure needs, costs, or requirements connected to redesignations of floodplain areas. At this time, the flood insurance program is still a federal program. However, the financial solubility of the current program has been questioned for many years. This will impact the insurance needs for new homeowners or those attempting to accommodate the redesignations of their real properties in accordance with changes to the floodplain upgrades in the respective area. Appraisals on the property are important for accurate assessment of the insurance needs. This would compel a serious reconsideration of the manners in which previous public investment has been effectuated. The maxing out of public assistance as a means by which to sustain the programs that were ostensibly for temporary relief, while people were not provided with the means by which to successfully acquire personal assets or credit, is a major problem. It is no different now than it was 10 years ago, or even 20 years ago. The only difference is that now there is a new sort of currency that is being employed without appropriate disclosure as to the means by which it was developed. There is supposed to be at this time a process of implementing disclosure by financial institutions and investors per the terms of the Basel Agreement, but it seems in lieu of adequately addressing the misuse of derivatives during these last years that it is represented as some sort of donation or fine for the purposes of recalibrating metrics in the scheme without appropriately addressing the underlying causes of the problem. This is unsustainable and the Federal Reserve has to know. Additionally, an executive order and an executive declaration in conjunction with the Department of Interior in 2017 emphasized increased access to broadband for rural areas. How are the lands upon which or in proximity to which new broadband towers are to be constructed to be assessed? Evaluation in respect to the existing changes to HUD via ascribement under the purview of the Department of Homeland Security calls into question frequencies that will be used in regards to various broadband networks in communities featuring mixed income real estate developments, as many urban areas have, and in any HUD housing in rural areas. Multi-family housing structures will have different requirements concerning apportionment of middle income or low income housing. This can impact not just financing for the mortgage, but also for any above ground projects, in addition to subterranean projects like the ones specifically mentioned in this proposal. That currency addressed above becomes even more important in these regards. And I'm going to stop here because it's been silent all day, and right as I'm going to read this, there's a phone call in another room, and the business matter is completely different from what I'm talking about now. And I know that. And that's part of what I'm talking about with the bundling. The way that they have a spectrum of broadband, and then they'll put something like this on a particular current, but you don't ever hear me or see me, and if you do, I don't know about it. And this is very, very valuable, and something else that has been deemed to have a better use value for public forums is allowed to get acknowledgement with an actual fucking phone call or actual in-person meetings. This is underwriting. In a way, shape, or form, this is underwriting. What about what, and I'm not even done yet. How much did this get taken care of in the last year? Housing, mixed income developments, broadband access. I'm almost done. How will the subsidies that were offered to various banks and financial institutions as part of the Troubled Asset Relief Program impact new mortgage considerations or considerations of refinancing? If you find a woman homeless on the street who nobody's talked to for years, and you bring her inside and nobody talks to her for a year while she's inside doing stuff like this, how much does it help you and your friends that are in the network she won't even be introduced to? Is that part of what the Troubled Asset Relief Program was really about? Was I a troubled asset and I was offered relief? See, the kind of asset I was could have stopped terrorist attacks. The kind of asset I was could have prevented COVID-19. Why was that considered to be troubled? I'm not going to continue reading this. I will put you can look it up actually if you wish. Unfortunately, for today, this is where the report goes. But this is how the report was programmed to go. And derivative litigation that was allowed to be connected to and interfering in my actual efforts at due process actually featured the program. And not only that, but it was allowed to be replicated into a completely different district, just like what otherwise could have been a responsible accounting and implementation of standards that could have forestalled what allowed to accrue as defaults that are currently financing this biological terror attack could also have been forestalled. But who actually deserved to get paid that wasn't allowed to get paid because the anticipated resale value of what they would be able to acquire as part of the leveraging was considered to be significant enough to risk entire national security paradigms for. In other words, how much are you willing to pay those insurance companies that paid for all of that medical treatment you needed during the Affordable Care Act? Because pretty much everything else mentioned here and everything else that could have been part of an actual political movement was subordinated to whatever was actually going on with the Affordable Care Act.